Hi, I'm Eitan Pinsky. I'm the owner of Pinsky Mortgages. This is Adam Clarke. He's the team captain at Pinsky Mortgages. Adam, I heard you have some questions for me today.
Yeah, thanks, Eitan. We've heard a lot about inflation over the past few months. Really quickly, what's inflation?
Great question. Well, inflation's been on the news. It's been in social media. It's been at my dinner table conversation. Inflation is really an increase in a basket of goods that you could purchase. So a basket of goods could be a liter of milk, it could be a liter of gasoline, your toothbrush, maybe a loaf of bread. And the government basically goes and says, we're going to pick 100 items or something like that, and says these items are going to cost X dollars or 100%. In a month or two, if those basket of items cost 102% of what it normally costs, then inflation has been 2%. So inflation really is an increase in the cost of the goods that we're purchasing.
Okay, so how is inflation affecting us right now?
Yeah, inflation is actually affecting us in two ways. I see it in two ways. The first is that, like we just said, that liter of gasoline, it's always been really expensive, but oranges, avocados, everything that you go to the grocery store to get is more expensive. Just toys are more expensive. I know I have an 8-month-old, and those things are pretty expensive. But it's affecting us not just in the way that our goods are more expensive. Inflation's affecting us because the government has to do something about it. The government's role is to keep inflation around 2%. That's what they say. And so when inflation is increasing, it means that the economy is generally doing better. In our case, the economy may or may not be doing better, but the reason why prices are increasing is because we have supply constraints. That's with goods coming into Los Angeles, which is or San Diego, I think that's the biggest port in North America, or if it's coming into Vancouver. The cost of goods is increasing, and again, that's generally because the economy is doing well. However, right now, it's not doing that well, and we still have an increase, but the government has to do something about it. So what do? They say, well, there's two ways of doing it. One is they can increase the prime rate. They can increase interest rates that the banks lend on. And then they say, okay, Mr. Bank, you're going to have an increase in interest rate. And the bank says, okay, Mr. Client, you're going to have an increase in interest rates. So that's going to affect us. And then when the economy does better, because we do have inflation, the bond market goes up. And so our fixed rates are also increasing. So when the Bank of Canada says increases in interest rates, that's the variable rate. And the fixed rates are based on the bond market, which has a direct correlation as well. So one, our interest rates are increasing because of that. And two, the number of items that we can buy on a daily basis is decreasing for the same amount of money that we had before. Yeah.
Right. Okay. Can you elaborate a little bit on how inflation is impacting the mortgage interest rates and where they're headed?
Yeah, so like we just said, when interest rates increase, our interest rates are going to increase as well. Right now, we've had quite a lot of talk about the prime rate or the variable rates increasing. Some people say it's going to increase by 1%. Some people say it's going to increase by 2%. Some people say it's going to increase by that 2%, but then decrease again because they think that supply constraints that we have or the inflation that we have is transitory, meaning it's not going to last. Some people say, yes, this inflation is going to last. Whatever does happen, we know that we're at historic lows of interest rates, so they're going to go up. But how much are they going to go up by and how long they're going to stay up and how long will it take for the interest rates to go up? We don't really know. But just know that right now we still are at historic lows of interest rates, and people, yes, they see that 3 months ago they could have gotten a lower rate, and today the rates are a little bit higher, they feel bad, but if they look at the 10-year average, they're much lower than what they've ever been. Yeah.
Right. Now, we get this question a lot. Based on everything that we know, what do? Fixed versus variable?
I love this question. So fixed or variable? Well, first off, fixed or variable, every time we talk to a client, the most important thing is a fixed or variable rate is not important for everybody. It's important per person. So it's important for everybody, but it's a unique situation. I can't tell somebody, you're going to go with a variable before I talk to them and ask them questions. So each person's situation will dictate whether or not we would recommend a variable or fixed.
Right.
So Adam, why would somebody pick a variable over a fixed rate?
Well, the penalty to cancel the mortgage within the 5-year term for whatever reason would be much lower than if you were with a fixed rate.
That's correct. So when we go and talk to somebody about a mortgage, we're really being impacted by their flexibility. We want to make sure that the flexibility that they have is there and that they don't have a huge penalty. I know that I personally paid a $35,000 penalty in 2020 to get out of one mortgage and go to another. That's huge. So penalties can be up to 5% of the outstanding balance of a mortgage. That's for a fixed rate, and that's when you pay it out. Statistically and unfortunately, a lot of people do pay out their mortgages. 68% of first-time home buyers apparently pay it out within 38th month. That's the CMHC statistic. On the variable side, however, the penalties are about 0.5%. So on a $500,000 mortgage, you're looking at a penalty from $25,000 all the way down to $2,500. So a 10 times difference. It's pretty high.
Yeah.
So based off of just the variable versus fixed and the penalties, the variable is the clear winner. Now on the fixed side, we do know that the rates are going to increase. But is the difference in interest rate from the variable to fixed enough to take the variable? So Adam, how much are the interest rates right now on the variable side? Or what are the interest rates?
Anywhere from around 1.2 to around 1.4%.
And the fixed rates?
Around 2.5 to about 2.9%.
So 1.2 to 2.5 and 1. Basically, there's anywhere from around 1.5% difference in interest rates from the variable to fixed. Right. When you have this big of a difference and you have a really high penalty, in many cases we would choose the variable. I'd say we would lean towards the variable for most clients. There are situations where the fixed is going to be much better for a person, and there's situations where the variable is going to be a clear winner as well. So I'd say 60, 65% leaning towards the variable for most people, but again, each situation is unique. And yeah, thanks for that question. So thanks so much for asking me questions today, Adam. If you guys ever have any more questions, you always know that you can reach us by email, phone call, carrier pigeon, by dolphin. We speak all languages, actually just English, and we'd love to chat with you.